Welcome everybody. This is Upping Your Capital IQ, what every founder should know about capital strategy. I know I've asked you all to drop some stuff in the chat here, but I'd also like to start off today letting you know that the webinar is being recorded. You can continue to drop questions along the way. I'll be monitoring the chat and jumping in if there's a question that makes sense in Carlos's flow. And as we get started today, and while I introduce Carlos, I'd love to I'm going to launch a poll here and just get a sense of where everybody's at with their at what stage of maturity their company's in while I'm here introducing Carlos. And so today we're going to have Carlos Antequera. He is the CEO of Novel. Novel leverages real-time data and analytics to help founders grow their company their way. They offer analytics strategy and most importantly, non-dilutive capital to help founders accelerate their growth. Looking like we've got a lot of bootstrapped founders on the webinar today, which is awesome to hear. I'm sure many of them have leveraged non-dilutive capital in their growth journeys. And so Carlos is a former exited founder. He exited his K-12 business Antequera to Vista Equity Partners and became part of People Admin. He is also a member of the prestigious Kaufman Fellows, an angel investor in his own right, and a mentor to many of his fellow founders, helping them grow and scale their businesses. So welcome, Carlos.
Thank you.
Excited to have this conversation or your presentation today with us. And yeah, so looking at the responses to the poll, it is looking almost half of everybody is bootstrapped. We got a couple in pre-seed, couple in seed, some Series A, and even beyond their Series B. So looks like we've got a really broad swath of participants today. Did you want me to I think you're going to present a deck, so let this switch over to you and let you share your presentation.
Perfect. Thank you so much, Lynn.
Yeah.
I'll go ahead and share my screen here. Make sure get the right screen. Oh, looks like I need the rights to share my screen.
Try now, Carlos.
Perfect. All right, so hopefully everybody can see my screen. Lynn, could you confirm that it's all good? Okay, perfect. Thank you, Lynn, for the introduction. I'm super excited to be here. As Lynn mentioned, I have had the opportunity to build a company before in the edtech space. I don't know if we have some edtech founders in the audience, but build that company for over 14 years, had the opportunity to exit that to Vista Private Equity, and now being the CEO and founder of Novel, have the opportunity to kind of experience building another company, now this time on the fintech space. And through those, to the journey with Antequera, to the journey with Novel, learned a few things that I think would be helpful for some other entrepreneurs that are in those early stages as well. And one of the things that obviously we learned through this process with our Novel customers, and one of the reasons why we started Novel, was partly because of the challenges of getting that growth capital when I had my previous company, right? And thinking about, okay, what are the ways in which other founders can build their companies? One of those key elements is capital to support that growth. And part of what we learned is that most entrepreneurs think of capital normally just as the traditional venture capital equity type of solution, and that's obviously one of the important ways to fund your venture and to fund your company for that growth and what you want to accomplish. but there are many other ways, and there are many other considerations as well. And so we want to share that with you. So hopefully you build the best possible company with the best possible outcome for you and your investors as well, and your employees and everybody that's part of the company. So one of the things that we've learned is that most entrepreneurs think that there is especially at the beginning, unless you're a second time founder, you've gone through this, that this is the journey that most of the companies fall, right? It's like you get your pre-seed, after that you're gonna get your seed round, then you get your seed A, your series A, sorry, then your series B, and hopefully you're on your way to an exit. Unfortunately, I don't think that's the way it works for most companies. Most of the companies that I've been involved with, the companies that my fellow entrepreneurs have been involved with, very rarely look like this. The most likely scenario is something like this, and it could be more convoluted even than this picture, right? But you get that pre-seed from, could be friends and family in a lot of cases. A lot of entrepreneurs have to even resource to credit cards and basically whatever way they can get just off the ground. Sometimes grants, sometimes pitch competitions, right? It's like however way you can just get your initial product built and try to get to market and try to really get that idea into something more concrete that you can kind of have and put in front of customers. And then in some cases, you will get to your seed round. You might get involved with some investors there, some angels, and in some cases, you might choose to just bootstrap the process. My previous company, I bootstrapped basically for the first 10 years, right? And so a large part of that journey was basically just funding it through organic growth, trying to get good at getting revenue from customers and building the company that way. But just to say that there's not a straight line journey, there's not a preset path that everybody follows. It's usually a combinations of things that you need to involve into trying to support the growth of your company with that capital. Sometimes it might be equity, sometimes it might be debt, sometimes it's a bridge that you need in between. Sometimes it's a mix of different tools that you get. And so you just kind of gotta be aware that the better understanding you have of all those financing instruments and tools that you can have in your toolbox as an entrepreneur, the best chance is going to be for you to optimize, to use the right tool at the right time for your journey. And so what are the things that are important to consider in your capital strategy? So when you're trying to decide how much capital you need, what type of capital or instrument you should use, what are the things that you should think about to make those decisions? So one of the key things is almost kind of step back or kind of think at a higher level, right? And think about what is the financial outcome or goals that you have as an entrepreneur, maybe you and your co-founders, long term, right? Are you aiming to be the next, Facebook or Uber, and you will not be happy unless you IPO your company? Or maybe you are just trying to really build up a meaningful company. I say, hey, if I build a company that is $20 million worth, and a lot of that value that I built accrues to me and maybe me and my co-founder, I would be happy with that outcome, right? So everybody has different goals, everybody has different needs and dreams. And so it's really understanding what really you're driving for, what would make you happy. And so that to an extent makes some decisions for you of kind of what the paths are going to be for you, right? The other part is impact, right? So one could be the capital side of things, the money, the outcome that you are trying to accomplish financially. And the other one is the level of impact that you want to have. Again, if your goal is to build like a really good business in your community, in your city, in your region, in your country, that's one set of options that you're going to have for that, and a set of things that you're going to have to decide on. But maybe you're not going to be happy unless you have a global company, right? And that's your ultimate goal. And therefore, then that leads you to a different path. The other question that's very important is, what is your timeline, right? If you're gonna, if you want to exit for $1 billion and you're trying to do that in the next 5 years, that is going to have a certain set of implications versus if you say, I would be okay if I exit for $100 million in the next 10 to 15 years, right? So that is one of the critical elements that you have to think and decide with your, with the folks that are the key stakeholders of your business. So if you have other co-founders or anybody else that is a key as part of your team, hopefully you get on the same page. So everybody's right. You don't want somebody that's trying to build a business that's 100 million, somebody else that's trying to build that $3 billion business, right? So you want to make sure that you agree on that and you think about those things. So what is the next set of things that you gotta think then is, once you've made those decisions, is really think about what is the amount of capital that you need, that you must have to accomplish the next milestone, right? And so a lot of entrepreneurs get caught around the again, kind of the glory of raising as much money as possible and showing up at TechCrunch, right? That doesn't necessarily drive the most optimal outcome for you. You might just need a smaller amount of money to accomplish the next milestone, to get to a better valuation or to get to a better situation in your company that you can then go to the next set of challenges. And so thinking really about kind of what is that number that you need to accomplish the next milestone, it's critical, and not be driven by what the size of check that an investor wants to put, or the again, kind of what appears to be what might make you look good out there if you raise an X amount of money, but really be driven by what is critical to the business for the next milestone. At that point, you can raise again more money, you can get additional capital, whatever form it takes, but do it in kind of well thought out chunks of milestones and goals. And so as you think about why is it important to think even about this, as opposed to just go, kind of gut feel, or just figure things out as you go, is because there are some real implications about this capital strategy and thinking about how you build your capital stack, if you will, for the business and for you as a founder, right? So here's a couple of examples of two different journeys, right? And everybody can have their own journey. Neither one is the right journey or the wrong journey in an absolute sense, but it is what is the right journey for you versus somebody else. So on the left, we have a company, for example, that is building over time, and over a time, let's say 10 years, which is right the median SaaS exit, that's the timeline, so it's pretty reasonable. You built a company with $20 million in revenue, you exit for 100 million, but because you made the right decisions and you were watching out for your dilution, you as a founder, or maybe if you have co-founders, you get to keep 75% of the company, right? So that was, for example, my experience with my first company. Is we were very, because we were bootstrapped the majority of the business, we were able to keep a large amount of the company under ownership of founders and management by the time of the exit. So here is one journey, right? Now, the other journey is you're going big, and in order to do that, you need to accelerate some of the things that you want to do. You got to take bigger bets. That means maybe you have to raise more money. In the process of raising more money, you get diluted. You get to a higher revenue. You get to a higher valuation, a higher value at time of exit, in this case, 500 million. But by the end of that journey, you only own 5% of the company. So you've achieved great things. You built a valuable company, but at the end of the day, the return to you and your co-founders could be much less in terms of net dollars, net value to you, right? So that's what I said in the beginning. Really think about what you're trying to accomplish, what's important to you in terms of your returns that you want, the company you're trying to build, the impact you want to have, because then that drives to that journey and those decisions. So again, neither one of these is wrong. It's just different outcomes. So you just got to be aware of those. One of the questions that I get the most is from most folks is around, how do I think about my valuation, especially when they're going through a more traditional equity fundraising process. And especially when you're very early stage, it is more of a black box, right? In which it's a lot of supply and demand, it's a lot of momentum, it's a lot about what market you might be in, like folks that are building AI tools over the last few months. That has been a hot area that is going to get a better valuation. But if we get past the one-off cases in which is, you're like in a super hot industry with a super hot tool that's on demand, or maybe your co-founder was the third person from Google and has a big brand name, right? There's a few edge cases, but if we take those out, right, the majority of founders are not in those situations. And they're so the things that they're going to have to consider when they think about their valuation, or how let's say an equity investor, a VC, or other equity investors might look at their business, is by this criteria, right? So revenue is one of the biggest drivers to that. So if you are pre-revenue or you have a small amount of revenue, your valuation is going to be smaller than if you have $1 million in revenue, if you have $5 million in revenue, right? So that's one of the critical drivers, that if you want to affect that value of the company, not only near term, but long term, revenue is the big element. The other element is growth, right? So how fast are you growing the company? If you have $1 million in revenue and you're growing 10% year over year, that's going to get a different valuation than if you have $1 million in revenue, but you're growing 100% or 200% year over year, right? So that lets people project, presuming that you maintain a certain level of growth where you can get over time in terms of revenue. See, it all goes back to the revenue number, right? So if you actually have a certain amount of revenue, that's even better than growth, because that is actually something that has been accomplished. It's not something that's going to be in the future. So growth is the next variable that you can kind of affect, that gives those signals to the investors. The next one is, right, what stage of the development is the company or the product, or you are in market, right? So if you have, and one of the kind of a lot of folks can get to describe, especially if you have a background in engineering or technology, or you are very product centric, like a lot of founders are, you get too caught around the features. The way I think more about the stage of the company is really about the customer base, right? So if, let's say, somebody has 5 customers, as an investor, somebody will say, okay, you've been able to sell. There's some people that like your product, but I don't know if this can really scale, if this is a solution for a large market, right? On the other hand, if you have 100 customers, then you know that there's enough people that like your product, and by deduction, you can probably decide that the product is mature enough that 100 people were willing to pay for it, right? And then if you look at other elements like your churn or your retention, then if that number is a good number, then you can also conclude that the product must be good enough and it's providing enough value that these customers are sticking with it. The customers don't want to get rid of the product because it's so good and it's providing value to them. So if you think around customers, that is kind of almost the better data point around the stage of the product or the maturity of the product, because it also gives you the maturity of your sales process, and the quality of the product by how many customers are sticking with it. And then the last element is, depending on the industry, depending on the stage that you're out of your company, there are certain benchmarks of multiples, right? And there's different ways of getting the multiples. Some people look at EBITDA multiples as companies are more mature, or certain industries. And in high growth industries like software companies, a lot of people look at revenue multiples. And so if you understand where those revenue multiples are at, and they're usually going to be times of the market in which those revenue multiples are, kind of move at a certain level. So if you think about 2019, 2020, there was a lot of momentum around a lot of technology companies. Those revenue multiples were, on average, they were pretty high. Now, over the last, I would say, year or so, those revenue multiples have come down, and people are, investors are a little bit more conservative. So if you're aware generally of those revenue multiples, in the software world, I usually think about like a 5x is a very reasonable number to use if you're kind of using a rule of thumb of kind of the value of your company. So if you do 5x of your revenue, then you're probably in the ballpark. If you have some other advantages, right, that number is going to move up from 5x to 10x. Let's say if you have some higher growth, if you have a larger amount of revenue combined with higher growth or a large customer base, then those are going to give you kind of bonus points that move you up from the base benchmark that most companies might have. So hopefully that gives you a little bit of sense to kind of how to think about, again, like a high level rule of thumb valuation. But obviously there's specific circumstances to each company that might affect that actual result when somebody's investing. And we're pretty excited that we're working at Novel always for with tools and other ways to help entrepreneurs build and grow their businesses besides providing them with capital. And so we're getting ready to launch here a valuation tool in the next 30 days that is going to be free for entrepreneurs to get. So if you want to have access to that, sign up to our wait list. As soon as it's ready, we'll send you a link to access it. So you can get an actual report that will produce based on a few data points. And actually it'll give you also, it'll give you a range plus where you stay, where your company is in terms of benchmarks of your industry and other companies. So pretty nifty report. If you're interested, please sign up. One of the things that I was saying is that you got to think about, the decisions you make around your capital strategy and how those might affect what you build or what are really the bad things that can happen. And so if you haven't read this book, it's, I think, kind of one of the better books for founders of a founder, Rand Fishkin, that really tells it like it is. A lot of founders want to highlight all the good things that are happening. They don't want to talk about the rough patches or the tough areas in building a company. And Rand does really a great job of being very honest about his journey and some of the decisions that he took in building his company and how they affected him. In particular, in his case, he took too much money from investors, and he couldn't keep up with the growth expectations that those investors had. And then you get into down rounds and you get into other issues in which, he highlights some cases in which, he had to leave the company at one point, and they installed a different CEO. There might be some other cases in which, based on those decisions, the company might end up in bankruptcy, right? If you don't make the right decisions around your capital or your capital strategy. And in many cases, what we see from entrepreneurs is that sometimes they get too many convertible notes, for example, that then those catch up to the entrepreneur when they're doing a round, or they get a pretty high valuation and they're excited about that, but then they cannot deliver on the numbers that investors expect, and they gotta take a down round that is very painful, or they cannot raise more money going forward. So just be aware that there are real consequences to not making the right decisions or not being thoughtful. So if you have the chance, read the book. It's a good book for any founder, I think. So how do you, once you think about, what your overall goal is, you are aware that bad things that happen. So how do you make the kind of the better decisions around your funding options? So one of the first things that I think is helpful to understand is that there's really no inherent bad instrument, right? So venture is not bad by itself. Debt is not bad by itself, right? So the different tools and financing instruments out there for funders, none of them by itself is bad, right? Even kind of, let's say, when you think about money from accelerators, right? So there are some accelerators that in order to give you money, they take a percentage ownership. So just gotta make sure that you're finding the right partner, that you're making the right decision in the context of what your overall large goals are and long-term goals are, and gotta make sure that for that type of instrument, that the terms are reasonable and in market, right? So there are, I'm sure you have heard of many stories of founders that have gotten VC money and they've gotten like horrible terms, or they've gotten taken advantage with, very high preferences or very aggressive terms that put them in a really bad situation as a founder. So you got to make sure that you're aware of what those things are. And in some cases, there's also bad partners, right? That regardless if it's equity, regardless that it's debt, they're not going to be the right partners for you. They're not looking for your best interest, or to at least have fair terms. And so you just got to make sure that you're finding the right financial partner for you and outside of the of the instrument itself that you're selecting. So what are all the different options that you have out there to build your company? So and we're not getting kind of a little bit at the very early stage, right? You have everything from grants, from friends and family, credit cards. You might have some also accelerators, pitch competitions, right? So once you get past that super early stage and you are post revenue, you are in a growth mode, then you get into a little bit more of the kind of the traditional instruments or traditional options, right? So these are kind of some of the most common, right? So debt is your traditional banking. So one of the challenges with that is that most traditional commercial banks are gonna look for a lot of history. They want profitability. They're really not very, they're very risk averse. And so for most entrepreneurs, tech entrepreneurs that don't have assets, right? You just have your computers, you have your IPs, in many cases in a few people's heads, then that's not gonna be a good match. In some cases, as you make progress, you might be able to get some lines of credit, but usually it's going to be smaller amounts that are tied to many covenants that limit you to the types of things you can do or the amount of capital you can get from them. Now, the positive of it is if you can get capital from a bank, I would say get as much as you can, as much as your friendly banker allows you to, because it's generally going to be the lowest cost of capital, right? And so there's some things at the bottom to watch out for, right? In many cases, if you're a very early stage, you might have to put personal guarantees. You want to make sure that you are aware of the cost of the fees, right? So sometimes banks will have here's your transaction fee, here's your legal fee, here's your unused money fee. So you got to make sure that you're adding up all those costs and be aware of those. Don't just look at the base APR and the amount of money. Be aware of the other items as well. The VC world, that's probably the most familiar, the area that most folks are familiar with. One of the challenges with it is there is less than 1% of companies, of startups that get institutional venture capital on a yearly basis, right? So there's about 500 to 600,000 new companies that get started in the US every year. If we just talk about US numbers, there's about 5,000 to 6,000 companies that will get institutional VC on a yearly basis, right? Approximately about 1% or so. So mathematically, your odds are really small to be part of that 1%. And it doesn't mean that you are not one of those. You just gotta be aware that if you are counting on that, it's gonna be a long process. Folks really want to get to know you. They really want to make sure that you check a lot of the boxes that they're looking for. They want to make sure that you're going to be a very large company with a possibility to IPO. And so not a lot of companies and business models meet that criteria. So just be aware of that when you plan, especially if you have cash flow constraints. Don't be counting on that because it might take longer than you expect, or it might not happen in some cases. And so again, the good news about it is if you can get it, in many cases, you can get a significant amount of capital. You don't have to pay anything in the near term, right? You just pay at the liquidity event. So some benefits there, just be aware of the possible downsides. And then the venture debt, right? A lot of folks talk about venture debt as a possibility, right? In my experience, part of the challenge is it's like the chicken and the egg. Traditional venture debt at least requires you to get venture capital from a respected VC, right? And so if you don't raise that venture capital, then you cannot really access venture debt. So that's one of the biggest challenges. If you can access it, the APR costs are a little bit lower than other options, but it's difficult to get for many companies unless they raise capital. And then also, in many cases, venture debt requires also warrants. So you're paying a cost of capital on the money and APR or interest rate. But in addition to that, you're getting diluted partially because of the warrant. So again, do the math on the overall cost, including your warrants, to really figure out how much is it really that you're giving up if you go that direction. But it's an option for some companies, especially if you raise VC. So what are the newer capital options, right? So you get many online lenders. The biggest pro is you can get pretty quick responses and get capital relatively quick through an online application. Part of the challenge is usually it's going to be a smaller amount, and in many cases, it's going to be relatively short term. So you might get 25K for 90 days, right? And so if you're trying to do something very strategic, like hire a person, that doesn't work very well because you got to repay it too fast, or it's not large enough for you to hire a couple of people or make some strategic investment. Crowdfunding has been an option that has been growing over the last few years with several crowdfunding platforms. Again, that's a great opportunity in some cases for some companies, especially if you have something that is on the consumer side that connects really well with consumers, or that has a really good story that appeals to a large public, because then you can get a large amount of money through those platforms. But on the other hand, if it's a little bit more of an obscure product, it's an enterprise product that doesn't generally create that consumer excitement, it could be a long process, it could be a frustrating process, or it might just not give you the results that you want, but you have to spend a lot of energy and time to promoting it and making it happen, and it might not lead to the results that you want in terms of the capital that you need to fuel the business. And then the category that we fall under Novel is revenue-based financing, in which we're looking at your company's data, and one of the key elements that we look is kind of the size of the revenue and the predictability of the revenue in order to provide capital. And so the good news is we can generally provide a meaningful amount of capital. We can provide it relatively quick within a transparent process. So it's not a black box like from the VC world, in which sometimes you don't know how long it's going to take and how much money you're going to get. We try to be pretty upfront about okay, here's the timeline, and here's the amount that we can give you pretty quickly to see if that fits your needs or not. But kind of on the downside, it's going to be more costly than traditional debt. That's why I said if you can get money from a traditional commercial bank, get as much of that as you can. If you still need additional capital, then you can look at the other options. And then it's not going to give you as much money as a VC, because part of the thing that we want to make sure is that you don't get over levered with debt, that then if you have a bad quarter or something like that, then you get in trouble. So a couple of constraints there that to watch out for, to consider. When you are receiving terms, again, regardless of the instrument that you are using or the partners that you are looking at, some of the things to keep an eye on or an eye out for. We see many entrepreneurs that really just focus on that, let's say on the VC side, valuation, right? They just focus on valuation so much. I'm getting money at this valuation and the amount of money that they're getting. And what they're not seeing is that you might have dilutive provisions, right? You might have warrants depending on certain situations. You are giving up board seats that imply maybe you are giving up control. There might be some other elements to the structure or to the term sheet that dictate rights of the investor in future rounds. So just make sure that you don't get so caught up around just these high level terms, which are the valuation and the amount of money, that you miss those other elements that could be very critical, right? So like your preferences, for example, right? Those could mean that the investor is gonna get their money first, all the way ahead of you getting your money in the case of exit. Depending on the size of the exit, that could be very challenging, in which you actually don't even get your pro rata rights of your ownership if somebody has pretty high preferences. So just be aware of that. Dilutive provisions, right? Make sure that you understand if there are success fees, warrants, or something like that are in addition to the main deal that you have, right? And those could be either on an equity raise or on a debt type of situation. Some folks, like in venture debt, they'll have warrants or success fees associated to that. Then financial covenants are critical. make sure that the covenants are not overly burdensome, especially if have a smaller team, you don't have a CFO, maybe in some cases you don't even have a controller. Make sure that the covenants are not so complicated that they're really burdensome for your operations, and you maybe, because of that, you miss some covenants that then get you in trouble, or because you're not monitoring those. I had a case of some folks that I know that they did not meet a certain level of MRR growth on some debt they got. And then when they wanted to get the money, they didn't realize that because they broke that covenant, they didn't have access to the money, and they already had made commitments of people they wanted to hire, and they were counting on accessing that money from their MRR line, right? So just be aware that you understand what those critical covenants are and the operational efforts to maintain those. Payback structure is pretty important as well, right? Again, if you think about a loan, not all loans are equal, right? Even if somebody talks about a 12-month loan, if you have to pay it monthly, it's different than if you have to pay it daily. It's different than if you have to pay interest only and you have to pay a balloon payment all at the end, right? So just a 12-month loan is not all the same from all providers. It's not all the same depending on the terms. So just be aware what that structure is and how does it align with the business and what you're trying to accomplish with your business goals. And then we talked about, the kind of the covenants and reporting associated with that. So keep those things in mind as you look at the different instruments that you might be considering to support your growth. So I think to wrap up, right, hopefully a couple of takeaways, right, is there's multiple ways to support the growth of your company when you're thinking about capital as one of those critical elements to support that growth. Traditional VC equity is not the only way to grow, right? There's other options. And regardless of which options you take or look at, again, just be aware of both your partner and the terms of that deal. And as not all options are equal, right? And then understand your metrics, and the more you understand your key metrics, is the easier it becomes to decide what is the right tool that will work for you. I'll give you an example, right? So if you are looking for equity and you are growing 10% year over year for the last 2 years, and you are courting traditional VCs, it's going to be very, very hard to get their attention and to close around with traditional VCs with 10% year over year growth, right? On the other hand, if you have been losing money for the last 3 years, and you go to a bank, again, unless your revenue is very high and your accounts receivable is very high, you're probably not gonna get money from those bankers because they're gonna say you don't have a history of profitability, you're at too much risk. So if you understand your metrics and you match that up with the requirements of the right financial instrument, you can narrow down what instrument might work for you best at this particular time of your journey. And so that way you spend the right time pursuing the right instrument to support your growth and not waste your time on just conversations that are not going to be fruitful. And like we started the conversation, make sure that you match the types of capital and your capital and build your capital stack to match up your short-term and long-term objectives. And that'll give you a better chance to succeed and to come up with an outcome that you really are looking for long-term, as opposed to, kind of go gut feel or try to satisfy other people's needs. In the process, you end up with an outcome that is suboptimal for you and your co-founders, which are the folks that are really putting the energy, the sweat and tears, and making all the sacrifices, over the life of your company. So hopefully this was helpful. Really appreciate you joining us today, and yeah, we'll try to answer some other questions that you guys might have.
Yeah, we had a few questions along the way that we can start
Perfect.
with, and please feel free, anybody on the line, to keep dropping questions in the chat, or you can send directly to the host here and we'll get them answered. I think the first one that I'm going to throw your way is, so we talked a lot about how VC is sort of the traditional path, and yeah, traditional equity rounds, not the only way. However, a lot of times that's what founders are going to do. So how do you get beyond that general, like, send me your deck and actually to a conversation with VCs?
I think the critical thing that VC is just like anybody else, right? They're trying to qualify you. They're trying to get data points from you to make sure that their time is valuable, right? They're getting hundreds of entrepreneurs reaching out to them, and somehow they have to filter that to the ones they think they really might have a chance to make an investment in. And so they're constantly trying to get data points from you as an entrepreneur to build a case that it makes sense to have a conversation. And then once they have a conversation, then to make sure that it makes sense for them to invest time into putting you to their process. So some of the things that they're going to be looking at it, some of the elements that we talked about, right? So IVC is going to look at, okay, what is your revenue? So if you send a pitch deck, they're generally not going to look at the pitch deck because they just get so many, right? Without understanding a couple of things. One, if they get a referral from somebody they know, right, which is one of the hardest things to do, that is giving them a data point that somebody else already has vetted you. And if they trust that person, then they trust that they ask the basic questions that match up to their thesis or to the way they invest or to the requirements. So for example, if I invest in SaaS companies, if you send me a request with your company that does something in the pharma world, I'm not even going to try to take a look at it. If somebody sends me a referral and somebody that I trust, then I'll know that that person knows that I don't do pharma, that they have already vetted for that, and they would only send me an entrepreneur that is in the software world, right? So that's how those data points get connected. In addition to that, I think it's kind of building to those metrics and to the things that the investor is looking for in their thesis. So if I invest in seed round and I invest in companies in the Midwest and I invest in, let's say, fintech and edtech, then when you're sending your request, make sure you match up, right? In your email or whatever communication you have, is you highlight how you match their thesis, right? You might say, I'm a company in this region and I already have $1 million in revenue and I am in the industry that you seem to have made many investments. So right away, as an investor, I'm thinking, okay, you've done your research. You're not just sending stuff to everybody. And yes, you match up a lot of these things that I care about. Therefore, it makes sense for me to spend more time even looking at your pitch deck or agreeing to a meeting. But it's really about how many data points can you put together for the investor that match up their thesis and catches their attention. The other thing you got to remember, right? A traditional VC investor is getting hundreds of pitch decks and outreach. How do you stand out from the crowd? Not just by talking about your product, uh, the way you talk to your customer, but what would be your pitch to an investor? So the pitch of your product to your customer, the way you sell to your customer is not the same the way you sell to an investor, right? So you got to have two different communications to those two different personas, if you will.
Awesome. We also had another question about like the best way to raise a seed round, and I think you addressed a bit of that. But any other guidance specifically for those who are trying to raise their seed?
Yeah, I think it's kind of what I said, right? It's like, okay, and understand, similar to kind of the sales process, know who your ICP, VC, or investor is, right? So don't go to somebody that doesn't invest in your industry. Don't go to somebody that doesn't invest in your round size, right? So if you go to somebody that only does pre-seed and you need a seed round, then it's not gonna, they're gonna pass. They're gonna say too big of a check or too high of a valuation, right? It's not gonna work. So um, uh, make sure to highlight the key metrics that they would care about, right? So I would start with, here's my revenue, here's my growth, here's my momentum, here's the other things that match up to your thesis. Those are probably your best ways. And then the other part, many entrepreneurs, many investors, and again, everybody's different, but they like to build a relationship and get the data points over time, right? So ideally, if you think about it, the job of, especially on the equity side, a VC investor ideally is to be the last check when everybody else already has given them the data points. The more data points they get, the lower the risk is. So they have very little to lose unless it's like a super competitive deal that everybody's fighting for a deal. They have very little to lose by keeping accumulating data points and information from you before they make a decision. So you want to be able to give them as many data points and reasons for them to make the investment. And sometimes it takes time for those investors to collect those data points. So it's generally not going to happen that you show up, you pitch, and you're going to get a term sheet. Some folks are going to want to meet with you, going to get to know you over time, going to make sure that the things that you told them you're working on the first time, a couple of months later, you have completed those or you have made progress. And that's how they kind of keep track of if you're delivering on results or you just have good ideas that don't come to fruition.
Awesome. Since we're almost at time here, I'm going to end with one last question here. So you are a former exited founder. You work with founders literally every single day at Novel Capital, helping them find non-dilutive capital options for their companies. What has been one of the biggest either learnings that you see founders have or mistakes you see founders make when it comes to their capital strategy? If there was just like one thing they should avoid at all costs, what would it be?
I think it's probably, again, don't run somebody else's race, right? Don't try to get X number, don't try to raise X amount because you are kind of trying to compete with your friends from that graduated from the same accelerator that raised more money, right? Or don't try to raise a bigger check, a $3 million check because that's the smallest check a VC is gonna do. It's again, if you are confident about your goals and how you want to build your business, then do the things that are right for you and your business, not the right things for somebody else that might be in the process. So
Awesome.
yeah.
Thank you so much. Carlos, if you want to go one more slide, we've got Carlos's contact info. If you would like to connect with him on LinkedIn or email him or even text him, we've got his phone number here for you. Thank you everybody for joining today. We'll be sending the recording out to all the registrants in the next 24 hours or so, and hope you have a great rest of your Tuesday. Thanks, everyone.
Thanks, everybody.